All right, we got everybody joining, coming in. We've got 17 people registered today. 11 so far have signed in, so I want to wait just another minute or two to get everybody on board. So it's pretty exciting for Dan and I both. This is our first ever live webinar, and we hope it goes well. We've been working with the technology to make sure we know how to operate it. So we're pretty confident we're going to get this to work pretty well. You guys are in listen only mode. However, if throughout the webinar, if you have a question, you can go to the bottom of the box there and click on Q&A, and you can type in any questions you may have for us. Dan is going to speak first, and we may answer some of his questions when he's done, and then some of the ones that you have for me when I'm done. So we'll try and keep it as organized and keep things rolling. We don't want to keep you here more than about 30 minutes. So about 12 out of 17 are on board, so I think we'll go ahead and get started. If you cannot hear or see us, please shoot me a message, but you should be able to see and hear both of us. As most of you know, I'm Alan Bewley, and with me is my partner, Dan Lomar. We want to talk just a few minutes today about what we've seen in our 5 years so far with dimensional funds. Just a quick note about why we picked dimensional when we did. We started out using active fund managers that try and outtime or outsmart the market by outpicking the market, by picking individual stocks they think will outperform the market or a given index. Dan found a bunch of research that showed, hey, that most of these advisors cannot overcome the cost involved in picking stocks. And so we switched to index funds. After a couple of years of using low-cost index funds, we realized that, hey, there was actually a better way. What drew us to Dimensional was their approach was strictly academic. And if you look at the people that started Dimensional, David Booth was working underneath Eugene Fama at the University of Chicago. Eugene Fama is the father of modern finance when it comes to how markets work efficiently. He went on to win the Nobel Prize in 2013. Kenneth French is another academic that works on the investment committee. There are a few others. They've got, I think, 3 or 4 Nobel Prize winning academics on the investment committees. What's interesting about Dimensionals, David Booth and his partner started the firm in 1981, and they started a small company fund. For the next 9 years, small companies underperformed large companies. The GEs and Microsofts of the world performed a lot better than these small company funds, but they stuck with what they knew the academic evidence showed, and it's served them well. As of today, I think the statistics are about 15% of active fund managers, those stock pickers that Dan and I were using in the beginning, about 15% actually outperform their index, where with Dimensional right now, I think a little over 70% of their funds are outperforming their indexes after fees, expenses, and trading costs. It's not really the performance that drew us with them. It was the academic approach. It was also we're not worried about a Bernie Madoff situation. These guys have been in business for a long time, and the way they approach everything is not only academic, but ethical as well. The last thing I'll say about this is David Booth has stepped down as CEO of the company and handed it over to 2 gentlemen. And just to kind of drive home the academic nature of the company, Gerard O'Reilly is one of the co-CEOs, and he's a rocket scientist. I mean, got a PhD in probably jet propulsion or something like that. But it just shows you the heart of the people that they use there. It's not just people who have advanced degrees or certifications in finance, but people who understand good research. So with that, I'm going to hand it over to Dan and let him talk some about the research and what we see. Dan?
All right. Thanks, Alan. Hey, as everybody doing? Glad you guys are here today. It's like I said, it's fun for us to have our first webinar, but I appreciate you being here. Anyway, so what I want to talk about today is the approach we take, that Dimensional takes and that we take, is called an evidence-based approach. It's not based on speculation on what we think is going to happen, but based on academic evidence of demonstrable performance differences, which are called risk premiums and some other stuff I'll get into. As airline pilots, how can we relate to this? I think the best way we can relate to this in looking at the evidence is, I think we all know someone who's afraid to fly, okay? They have no problem getting on a busy highway and driving their friend to the airport, but there ain't no way they're gonna get on an airplane. But all the evidence suggests, overwhelmingly suggests, it's safer to fly than it is to drive, okay? So I think we can relate to that. So when we talk about the evidence, that's what we're talking about. Those people that are afraid to fly are making an emotional decision. And so are we dealing with emotions here as pilots and investors? Absolutely, we still are. And I think the biggest thing we're dealing with is, as we look at the past 5 years, is mostly patience. And that is, we need to be patient in our approach, and so we don't want our behavioral, our emotions of being impatient to stray us away from what the evidence suggests. So that's kind of the building, the basis of what we're going off of. So what we're going to look at as I go through these slides is a building block approach, do some investment basics 101, and then and we'll just kind of build up to there. I'm going to take control of the screen here. Oops, oh, Alan, you just gave it to me. Okay. So anyway, starting back at the very, very basics. Let me see here. Here we go. So let me start by asking a question and looking at a little slice of evidence that we're looking at right here. And this is what most people would look at. Is we started looking at this the past 5 years, and when we come to make investment decisions and investment selections, the majority of people would say, all right, hey, the S&P has done better than these two investment alternatives for the past 5 years. That's good enough for me. I consider 5 years the long term, so I'm just going to run with the S&P 500. Keep in mind that the past 5 years is about 5%, maybe rough plus or minus a little bit. It's about 5% of all the available information that we have available to look at. So as I go through these slides and build back up, I'm going to build back up to this question to see what your answer changes to. So anyway, that's a little bit of what we've seen the past 5 years. Is these are not our mutual funds actually, but these two indices are what our mutual funds are modeled off of. But just kind of keep that in mind as we go through. First of all, let's talk about just investment 101. What is risk? Okay, risk, when we're talking about investing, is just a variation in return. It's a sound fundamental principle that if we want to get a return better or have a what we call a higher expected return than a money market, than a money market fund. Sorry about that. Then a money market fund. Then
sorry, that was my fault, Dan.
Here we go.
There you go.
Then we have to be willing to accept that risk, that the return is going to be uncertain, and sometimes it's even going to be negative. So that's something we have to accept as investors. Now, that does not just apply between stock funds and money market funds. It also applies between two different similar stock funds. Okay, so the variations in return, which we call tracking error. If one of our funds that we're considering has a higher expected return than the other, then there's going to be tracking error. There has to be. They cannot be identical, otherwise it'd be impossible for one to outperform the other or have a higher expected return. So with that being said, when there's tracking error, there's also going to be times when that higher expected returning fund is going to underperform also. So that's just the nature of the beast. That's the way it is. So we have to be able and be willing to accept that idea as we compare investment options. And the same thing is when we go back to our behavioral and our emotions, is we have to know what to expect. Okay, so tracking error isn't just between our investment options. Sometimes it's also between what we expect and what the actual investment does. So that's just something to keep in mind as well. So that's kind of what we're going through here, is setting those expectations. But as we go through, as we look at these variations in returns, it's not all just a negative thing. We can actually use these to our advantage. And so when we take different types of investments and kind of overlay them over one another, and this is a very simplified graphic, when we overlay them over one another, we get diversification. And so what we get through diversification is a smoothing of the return in the portfolio itself. Now, it's not exactly completely smooth, but we do reduce some of the variation when we diversify and we have different, and we invest in different investments at the same time. So if we were to so another question we get, and this is another thing that investors might tend to do, is that, well, if we have one investment or one mutual fund that we expect to outperform all the others, well, who cares about these variations over time? Why don't we just go with the one with the highest expected return? And a lot of people do that. And even though it might be diversified because it's a mutual fund, but we're still taking some risk here. And the one, there is no guarantee that it will be the highest, that we will have the best return of that one mutual fund over time. Secondly, like I demonstrated before, there can be long periods of time where that highest expected return underperforms, okay? And a good example of that is like during the U.S. markets were negative over a 10-year period from 2000 to 2009. We had actually, I think it was an overall like a minus 9% return. Don't quote me on that exactly. Over that 10-year period, yet international funds actually held up and were positive. Emerging markets actually did very well over that 10-year period. So even though we might have one asset class with a higher expected return, it's still good to diversify. And the other thing is that the research would suggest that even if we have one individual stock or one individual fund, that we still have to have something to diversify with. Otherwise, we can't even take advantage of what we call the equity risk premium. So the times that it is outperforming, that diversification gives us the advantage of actually rebalancing, gives us the opportunity to take some of those profits off the table and kind of store them in a safer place. So that's another reason we diversify and why we can take advantage of those variations in return. So the thing is, when we just come down to it simply, these variations in return are simply what we refer to as risk, okay? And if we go back to the basics of risk, I like to say there is dumb risk and there is smart risk, okay? And dumb risk is that there is so many things that can happen. And then what we're talking about is like with individual, if we were to buy an individual company, an individual stock, and there's so many things that can happen with an individual stock that it's uncertain. I mean, you can't even measure it. And so like, I consider it dumb risk because we don't actually know what could happen. Now, it could do great. It could be the next Apple, but it could also be the next Enron. And the thing to keep in mind as we're talking about risk, a lot of times we throw that term around here so often about variations and technical matters and stuff like that. But what are we really putting at risk? And what we're really putting at risk is our livelihood. It's our quality of life. So always keep that in mind. So I mention this because a lot of times we hear these stories, these success stories about someone who walks in, I put their entire retirement into Apple or Amazon, and they're just killing it. But what we don't hear are the 9 stories in which someone did the same thing and they got killed instead. So, always keep that in mind. It's never the full story when we hear these success stories. Anyway, so smart risk. So something we can relate to is, as airline pilots, is that smart risk is, yes, we are taking additional risk in winter operations, but we're taking it smartly and we're taking it measurable, and we expect there to be a payoff because of the way we're doing it. So when it comes to investing, we might say dumb risk is buying an individual company or a small handful of companies. That's okay. So we can do better than that. So we've got this entire universe of markets and bond markets and real estate markets we could buy in. So not doing that kind of in a not so smart manner would be by just buying the one individual stock up here, just a handful of them. So what we do instead is Diversify. So instead of just having that one, we diversify into an entire segment of the market. But as we showed, each one of those segments of the market has different variations, different return characteristics. So we want to spread that risk out as much as we can and to buy as much as we can all segments of the market. So not just US, large cap, small cap, international, real estate, and the bond market. Okay, and now we've diversified all these risks out, and so what we have is market risk, which we consider to be an acceptable amount of risk, and that we can have a return. We expect to be rewarded for the risk that we're taking. Now, another question that comes up is, well, why isn't there somebody out there that's smart enough just to know what market segment is going to do the best next year or the worst next year, whatever the case may be? And we'd love to have that. And if we had any ability to do that, then we wouldn't be sitting here talking about it right now.
You wouldn't know our name if we knew how to do
we'd be out on the yacht. The fact of the matter is, nobody has ever demonstrated the ability to do that with persistency consistently. And so if you look at this chart right here, this is called the randomization of returns. And you can tell that there's no discernible pattern here. So each one of these colors is of a different market segment or asset class of the market. And so these are the best performers year to year. These are the worst performers down here. And you can tell there is no consistency. There's no pattern here that we can try to take any guess off of. So that's why we don't try to guess what's going to be hot next. And that's why we invest in all market segments at the same time. So if we do that, and we did this with a typical index fund, this is kind of what our exposure would look like. We wouldn't have every single individual stock out there, but the way things would perform is that they would look like we did, okay? Well, a typical index fund is very weighted towards the largest companies in that index. So whether that be the S&P, whether it be the Russell 3000 or whatever index you choose, the performance is largely driven by around the largest companies in that particular index. So Dimensional said, well, that's great. And if this is all you do in a typical ETF in a low-cost portfolio, and this is what Alan and I were doing for a while, there's nothing wrong with this. This is a great approach to do this. However, when Dimensional did the research, they said, well, is there a better way to do this? And they said, yes, there is a better way to do this. And they did it around what they called the dimensions of expected returns. And so they said, well, you know what? There is evidence that suggests that small companies have a higher expected return than large companies. And there's evidence that suggests that value-oriented companies, ones that have a lower price-to-book ratio, have a higher expected return than growth companies. And the same thing applies to profitable companies or more profitable companies versus less profitable companies. And so if you think about the concept that we can all expect that generally it's accepted that we expect higher returns from the stock market than we do from the bond market. And I don't think too many people would argue with that. And the same concept applies to these different dimensions of return. So company size, relative price, and profitability. So when Dimensional did the research, they discovered these. They go, all right, well, instead of just investing in a typical index fund and buying everything, there are some things we want more of, and there's some things we want less of. So if we looked at the universe of stocks, this is not an exact demonstration of the way it'd be weighted, but you can see there's some things they don't have any of, and there's some things they would have more of. And so their portfolios are tilted towards small cap companies and towards value companies. And that's what makes, that's the biggest difference. And then also towards companies that are more profitable than lower profitability companies. So that's what makes our dimensional funds different than your typical index funds, even though they're still low cost and low turnover funds. So if we look at the evidence that supports this, we're looking at not just 5 years of evidence like I showed on the first slide, but we're starting to look at much longer periods. This is almost 90 years. And that small cap premium was about 2.3% over large cap stocks over that 80-year period. And it's not just the US markets, which is right here. It also, that was persistent into international markets and into emerging markets. And then we also see the value premium played out over the past almost 90 years, 3.5%. That's not just U.S. markets, but international markets. So we see it persistent across markets, and the same thing with the value, with the profitability premium.
I'm going to say something real quick here. We may have a few people that aren't quite sure about company size, small cap versus large. Basically, companies are measured in size by the number of shares times their price, their outstanding shares by the price. So somebody like an Apple or an Amazon are huge, large cap companies because their market capitalization, the number of shares outstanding times that price, is a huge number. Whereas a smaller, obscure company that you've never heard of has got a much smaller market capitalization. The index funds, because you put an amount of money into their index fund, just so much more goes into Apple and Amazon and Microsoft because they're just bigger. But as Dan's showing right here, the evidence shows that these smaller companies we've never heard of, for example, average annualized return has been almost 2.3% higher per year over 90 years, small versus large. Relative price is just companies whose current price, whether it's priced to their book value to earnings, about 3.5% a year, those companies with lower relative price, they're also called value stocks, have outperformed by these blue numbers that you see here. And then lastly, like Dan said, it's just companies that are highly profitable tend to outperform those that don't have quite as high profits. I just want to make sure everyone got the company size and price.
Absolutely. Definitely. Yep. Thank you for pointing that out. So as we look at the evidence, so this is now where we start looking at the evidence that demonstrates these higher expected returns. Now, instead of going through this and look at every year by year, we don't necessarily have to do that. But this is if you were to look at this, these observations on a yearly basis, this is what it would look like. Let me see. And then let me see here. So we could go through this on a year-by-year basis and look at all of the evidence, but it's not necessary to do that. So here's a year-by-year observation of small cap versus large cap. And it's a little bit noisy because it doesn't persist every single year. Okay. But if we start to look at it over longer time periods, okay, these are called 5-year premiums, 5-year rolling periods. It's a little bit less noisy. Okay. All these different premiums we look at. And this is the actual evidence that we're referring to when we refer to evidence-based investing. And then we look at 10-year periods, 10-year rolling periods. It's even smoother. Okay. So the evidence, again, these premiums don't play out every single year. They're more likely to pay out over longer time periods. But if we, instead of looking at it, the chart I like is that instead of looking at it on a chronological basis, this is the one that tells the story for me. Okay. And so this is just an example of our value companies over our growth companies. So in other words, the portfolios, again, are tilted towards our value companies. And this is the reason why. These are 10-year periods right here. And these are the premiums in which value had over growth stocks. And so if we are to say to ourselves every single day when we wake up, if we had to make an investment decision, not based on the past 10 years, but based on the next 10 years, and we looked at all of the evidence, and nothing in investing is guaranteed, so we go with probabilities. When we look at a chart like this, we go, what is the probability that value is going to outperform growth over the next 10 years? Because these are all 10-year time frames. And so if we look at this, we go, well, the evidence suggests that yes, I'm going to invest a little bit more in value than I'm in growth. And so that is, this to me shows what the probabilities are. And if we look at what we are in the past, if we look at what we are end of last year, we're right here. Okay. So this is where we've been. And this is why we've seen a little bit of that underperformance relative to the S&P or some other common benchmarks, is we're right here. And again, this is expected. This is not anything unusual. Oops, sorry about that. Because again, the majority evidence supports what we are doing. So anyway, and this is value versus growth companies. The same concept would apply for small cap over large cap and profitable, highly profitable over less profitable companies. So we're not going to go through every single one of those slides, but the same concept applies. And Alan has a slide that kind of talks about it a little bit more specifically. So when we look at the evidence, and we look at not 5 years, but this goes back almost 40 years. And now we kind of look at it a little bit differently with more information. And this still isn't even all of the information. This only goes back almost 40 years, but what we've looked at largely is we've looked at 80 years of data. And now we'd say, now which one would we be more apt to buy based on the information we have available to us? And as you see here now, the S&P is the laggard behind those when we take all the evidence into consideration. And so as we revisit that original question and we look at 5 years of information and we see based on the evidence, it's only about 5% of the data, less than 5% of the information that we have available to us. So I hope that has shed light on kind of from the basics up to the way the portfolios are tilted and the evidence we look at every day to make the investment decisions that we do.
Very good. Thanks, Dan. Yeah, it's funny. Dan's exactly right. You know, whether you're a pilot like Dan and I on this call or whether you aren't, we've got a few non-pilots here. You know, when Dan and I go to work, when a lot of you are sitting in the airplane and investments come up, your fellow pilots tend to tell you a lot about all the home runs they've hit, but they rarely tell you about their losses. And it's funny, they like to tell Dan and I those stories because, you know, when they learn this is what we do. But what I will say is those people that do admit their downturn or their shortfalls in investing, some of you are on these calls today. Some of you have become clients of ours because you've realized kind of what you've done in the past hasn't worked. The other thing that is interesting to me about DFA and their research is you know, it's based kind of initially on Eugene Fama's work that he did almost 60 years ago with the efficient market hypothesis. And so, you know, what he likes to say is in Dimensional, we work with one idea a decade. They've got these 4 premiums here, but they've also got a premium for fixed income. And so these 5 premiums are once in a decade thing, but for fund managers that tend to pick stocks, they come up with 1 a month. So who are you going to rely on? So we're going to talk about, Dan mentioned risk premiums. All right. We accept market risk, right? When we invest in the market, we accept that in order to get a higher return over T-bills or treasury bonds, we're going to have to take more risk. And because we're so broadly diversified, our risk isn't necessarily the worry of one stock going away or even a sector having a bad year, because we invest in all of it, 45 countries, 12,000 stocks. The risk we take is that the premiums that we seek will underperform over any given period of time. Risk premiums. So let's look first at kind of how the 2 U.S. core dimensional equity funds are constructed to give us an idea of what the tilt Dan talked about looks like. So the left-hand side is kind of the makeup or the market capitalization, if you will, of the Russell 3000, the U.S. market. And this shows over on the left-hand side here that a lot of their money is weighted in large companies. And the left-hand side here towards you, it's a 3-dimensional shot. This is large growth companies. That's where a lot of the money is. Well, the academic evidence shows us, but that's not where the higher expected returns are. They lie a little more over here in the smaller companies and the value companies over kind of to the top right. So this is Dimensional's Core 1 equity portfolio that has a slight tilt towards small in value compared to the market as a whole. They own pretty much all 3,000 stocks in the Russell 3000, but with a weighting towards small in value. The portfolio we use as our primary anchor U.S. core portfolio is their Core 2 equity portfolio. And you can tell it has more of a tilt towards value and more of a tilt towards small companies. And I'll go back so you can look to the right-hand side. Core 1 has a slight tilt. Core 2 pushes weighting more kind of that top right, the small value, to capture more of that premium over time. Now, we take the risk in the short term that these premiums may not play out to try and capture the higher premium over time. So what has happened in the US over the last 5 years since we've been using DFA, December of 13 to November of last year? All right, so first let's look at the small company premium, okay? The left-hand side, the size of these bars don't really necessarily mean anything, but as far as it's not on the scale, but the premiums did not play out over these last 5 years. When it comes to the small company premium, large company stocks outperform small by about 3 percentage points per year. Did we expect the premium to play out? Sure. Are we surprised it did not? No, it happens. Growth versus value. Growth, higher price companies, higher relative price companies outperform lower or value price companies, okay? Again, our premiums didn't show up. And this one was even more tilted towards growth. So about 4% per year, growth outperformed value, and then back large outperformed small by about 3 percentage points per year. So it was pretty considerable underperformance of the premiums or lack of the premium showing up. But again, this is not out of the ordinary. The value premium, value outperform or growth outperform premium, growth outperform value by about 4 percentage points per year. Well, that's happened before. This is not something that's never happened before. This is kind of where we sit right in this graph that Dan showed you earlier. However, let's look at what the funds actually did versus the index. So the Russell 3000 earned 10.6% a year over these 5 years. Okay, the Core 1 fund that has a slight tilt towards small in value underperformed, but by less than 1% a year. And then Core 2 that has a pretty moderate tilt towards small in value underperformed the index by less than 2% per year. Now remember, value underperformed by 4% and growth underperformed by 3%, yet these core funds really, really did well compared to where the premiums were. And that's something that Dan and I are actually really, I'm not gonna say we're excited about it because we don't want to see these times that happen, but we're very encouraged. And we've learned a lot about how Dimensional runs their portfolios, and it helps explain why they're able to do this well under these situations when the premiums really don't show up at all. A lot has to do with their patience in trading, keeping costs down, but part of it has to do also is that since they own every stock in the universe, they are able to lend securities out to other firms. And when they lend securities, they get a fee for that. Well, most advisors, and this is another reason we love Dimensional, most advisors take that fee and put it in their pockets, the managers, not Dimensional. Dimensional puts it back into the fund, and we as shareholders capture that to help recoup some of the return when the premiums don't play out. Another reason we love Dimensional. We'll look at internationally as well. Same picture. This is the international index right here, the MSCI World ex-US. It's very heavily weighted towards large companies, a little bit value related. But the international core equity portfolio of Dimensionals focuses more again towards mid and small companies and value companies, more so than international index. Why? That's where the higher expected returns lie. The emerging market portfolio is the same way. It's interesting over here, the emerging market index, there are very few large companies in the Brazil, Russia's, India's, China's, Southeast Asia, Latin America's of the world. There just aren't any giant large companies. But again, that's fine because Dimensional tilt towards the premiums, small in value. So what's gone on over the last 5 years, have those risk premiums shown up? Well, this is international. This is the developed world, the Western Europe, Australia, Canada, South Koreas of the world. So the international small caps were the best performers of the last 5 years. International value slightly outperformed the market. So the market's over here, small companies here, and values here. So very slight outperformance value premium and a pretty good outperformance small premium. And as a result, Dimensional outperformed the index after fees, expenses, and trading costs. The other thing to mention here, internationally investing costs these firms a lot more money than domestically. In emerging markets, it costs a lot more. The ability to outperform with including your cost of doing business gets harder and harder in some of these foreign countries. So we were glad to see this here, and it made sense. The premiums played out, and Dimensional outperformed. Emerging markets tells a different story. It's more like the US. The value premium underperformed and the small cap premium underperformed. If you look at the numbers, the index outperformed value by a little over 1% per year and about 0.8% per year of the market over small cap. However, and these bars are not representative, however, the portfolio, Dimensional's fund, only underperformed the index by about 0.1%. Again, that is a testament to their ability to capture returns, to keep costs low. But what's interesting about this emerging market core equity fund, I told you a second ago that Dimensional lends securities to other firms and takes a fee for that. Dimensional is one of the only firms out there that invest in these small emerging market companies. And so as a securities lender, those securities are very highly sought after. So Dimensional lends out a lot of securities out of their emerging market portfolio, and they do it to such an extent that they capture almost the entire expense ratio in the fees that they receive lending out those securities. And they put that back into the portfolio for you and for us to take advantage of. So, you know, we talked about these periods of time in the emerging markets and the US where we are underperforming, or the premiums are not showing up. Again, is that a surprise? Well, one thing that, you know, Dan showed you on that kind of seesaw looking slide, and this explains a little better. Every day we wake up expecting the premiums, okay? We're not surprised when it doesn't show up. But the other thing is that the longer we wait, the more likely it is the premiums will show up. So the top right corner here looks at the value premium, and this is the one that's been underperforming the most over the last 10 years. But if you go back to 1926, there have been 979 rolling 10-year periods back to 1926. 84% of those, 84% of the time, the value premium has shown up. Guess what? We're sitting in one of the 16% of the time right now. We're in one of the 25% of the 5-year periods when the premiums don't play out. And we are also in one of the 39% of the time when the 1 year, in the 1 year periods. So the thing that we are, I think, encouraged about is we are sitting in one of these 10-year periods right now, actually probably approaching 11 years with value. And we've been with Dimensional for about half of that. So I'm not going to sit here and say that the premiums should be showing up anytime, but you would expect it to, because this is one of the longer periods of time. The same goes for the developed markets. The longer we wait, the more likely it is the premium's going to show up. And then the emerging markets. So we do have some clients that are in their 70s. My father is my oldest client. He just turned 80. So I do get the question of, hey, am I going to be alive by the time the premium shows up? Well, yes, I would think every one of you should be. But not only that, this money is typically not just for you. A lot of you have a spouse that's younger. My mother's younger than my father. But also a lot of you, your heirs end up inheriting some of this money when you and your spouse both pass. And that's even more time for these premiums to show up. So, you know, when all of you guys come on as clients, the first thing we do is build a plan. We want to make sure that you are living the best life you possibly can with the money that you have. And that comes in with your financial plan and us figuring out what life it is you want to live. Once we've built the plan, the first thing we've got to do is advance your money with science, because everything else is simply guessing. So I wanted to open it up. I don't have any questions at this point. If you have any questions, you can click on the Q&A button and type in any questions. And I'll wait just a second here to see if anybody has any. All right. It doesn't appear that we have any. So with that, Dan, you got anything else?
No, nothing else. I think we covered what we wanted to. And if any of my clients are on and you want to talk about it more specifically with me, I'll be more than glad to do that.
All right. I did get one question. At what point will/do you abandon the plan? Never. I'm not sure why you would. If if all of the evidence, 90 years of evidence isn't enough to prove, that this is the only way to potentially outperform the market over time, we're not seeing significant underperformance. Matter of fact, again, we're seeing very close to market-like performance while pursuing the premiums, which is, to me, impressive. So, yeah, I think the answer is be patient, and our patience will pay off.
Yeah, Alan, the one thing I would add to that is abandon it for what? And
exactly.
And the reason I ask that is because what other evidence is there that something else is going to do better? Or so that would be my answer is as soon as there is evidence of a better way to do this, absolutely. But until that comes up, we stick with it.
Yeah, we're open to suggestions. You show us the evidence that proves that what we're doing is not the best way to do things. Yeah. Another question, a good one. Is there a fixed date when you buy this or every quarter? Yeah. So for those of you that are contributing to your accounts, whether it's you and United to your United retirement account or whether it's to some other account, we're very systematic about this. We use the 20th of the month of the last month of every quarter. So March 20th, June 20th, so forth and so on. And we do this so we're not trying to guess, when, there's a market dip, maybe we can buy into this. Sometimes we win, sometimes we lose. But I'll tell you what, it was interesting. We ended up buying around December 20th was luckily, and it's all luck, was about the bottom of the market this last year. But not only did your contributions get reinvested at that time, but if you go back and look at your transaction history at the end of last year in December, the mutual funds pay out some distributions. They take gains and they pay those out. Well, those got paid out into your accounts in December and they got reinvested at market bottoms. It was very lucky, but it could have been market highs. And actually, yeah, investing your contributions in September was probably closer to the high for the year. You got anything else for that, Dan?
No, nope.
Okay.
Just systematically do it every quarter, and try not to think about it actually.
Right. And for those of you that are retired and are living off of your investments and pulling income out of it, we basically we rebalance annually. Essentially, when we set aside 1 year of cash, and as you're pulling your cash out monthly, as you run out of cash at the end of the year, we rebalance. If the markets have done well, equities, we end up rebalancing, taking stock gains off the table and using those to replenish your cash. If stocks have done poorly, we take bonds or other cash you already have there and set that aside. So it's very systematic. It keeps the guessing game out of it. And it also ensures that we don't sell equities at any time when they are down, when they've shown losses over the previous year. All right, well, that looks like about it. We took 43 minutes of your time. We promised 30, but I hope everyone found this helpful, informational, and please email Dan or I some feedback on other topics you guys want us to talk about, because we'd like to start doing these about once a quarter. So, all right, guys, thanks a bunch and enjoy your weekend.
Thanks, everyone.
Thanks, Dan.
You bet. Thanks, Alan.